If silver was a dead asset, why does one bank now control more of it than most nations? JPMorgan. They spent 15 years accumulating physical silver while telling everyone else it was worthless. And now, right now, their positioning has flipped from suppressor to beneficiary. China just restricted silver exports. COMEX warehouse withdrawals are accelerating. Lease rates are firming. Physical premiums are climbing off screen. But price still looks contained. If you're stacking metals, watching commodities, or just tired of being the last one to see what's happening, you're early to this. The real tell isn't price. It's who stopped defending it. We're not here to predict. We're here to watch flows while everyone else watches headlines. And right now, the flows are screaming something the charts haven't caught yet. Your job is to understand the structure before the stampede. Hit subscribe if you want to stay ahead of positioning shifts like this. We don't chase rumors. We watch what institutions do when they think nobody's looking. Here's what changed. For over a decade, silver stayed range-bound, mid-teens to mid-20s, boring, predictable, dismissed. Meanwhile, JPMorgan, through COMEX-linked warehouses and subsidiaries, quietly accumulated somewhere north of 1 billion ounces of physical silver. Not paper, physical. They weren't alone in shorting futures while buying metal, but they were the biggest. The pattern was simple. Cap volatility in paper markets, drain physical supply in the background, wait for industrial demand to do the rest. And now, the cap is lifting. Not with headlines, not with a price explosion, with silence. Liquidity providers who used to lean short every time silver rallied, they're stepping aside. Lease rates, the cost to borrow silver, are firming. That doesn't happen when supply is abundant. COMEX registered inventories are draining. Physical coin premiums are rising at major dealers. China announced export restrictions on antimony and gallium, but silver's on the watch list too. Industrial users are locking in supply now, not later. Here's the hidden layer. Suppression doesn't end with a bang. It ends when the suppressors stop showing up. Think about that. This is what I call the accumulation-then-release pattern. It's not new. It's not unique to silver. You've seen it in oil, copper, even grain markets during supply squeezes. Here's how it works. A dominant player, usually a bank or a sovereign fund, identifies an asset that's hated, boring, or structurally mispriced. They start accumulating physical supply while simultaneously managing paper positioning to keep volatility low. Why low volatility? Because rallies attract attention. Attention attracts buyers. Buyers drain supply faster. So they build the dam quietly. They short futures to offset physical buying. They lease metal into the market to keep spot prices capped. They let sentiment stay bearish for years. The public watches price. Price stays flat. The public loses interest. Meanwhile, the physical drains. Once enough supply is locked up, once the float gets thin, they stop defending the range. They don't need to push price higher. Scarcity does it for them. The dam doesn't explode. The engineers just stop maintaining it. That's where we are now. JPMorgan's short positioning in silver futures has unwound significantly over the past 3 years. Commitment of traders' data shows a structural shift from net short to net long exposure among commercials, with ties to physical operations. At the same time, warehouse stocks at COMEX have dropped from over 400 million ounces in eligible and registered categories to under 300 million. Registered, the immediately deliverable stuff, is under 50 million. That's roughly 2% of annual global silver demand sitting in the exchange warehouse. Circle this. When the biggest suppressor becomes the biggest beneficiary, the game changes, not advice. Pattern recognition. This mechanism repeats because institutions need 3 things: time, opacity, and boredom. Time to accumulate without competition. Opacity. So retail doesn't front-run the trade. Boredom, so nobody asks why they're buying a dead asset. Silver gave them all 3. Now let's add the second layer. The industrial drain valve. Silver isn't a pet rock anymore. It's not just coins and bars sitting in vaults. It's consumed. Solar panels use roughly 20 grams per panel. EVs use 25 to 50 grams per vehicle. AI data centers, those massive energy hogs everyone's building, need silver for thermal management, connectors, and power distribution. Every tech build-out, every energy transition, every electrification mandate pulls silver out of the system permanently. And here's the kicker. Industrial demand doesn't negotiate. If you're Tesla and you need silver to build the battery management systems, you're not waiting for a dip. You're locking in supply at whatever price clears. If you're a solar manufacturer and your production line stops because you can't source silver paste, you pay the premium. That's inelastic demand. When demand becomes inelastic, paper pricing loses control. Imagine you're a futures trader. You're used to selling silver rallies because historically, rallies fade. There's always physical supply available to meet delivery. The market is liquid. Price mean reverts. But now, physical is rerouting to end users before it even hits the spot market. Refineries are running backlogs. Mints are reporting delays. Dealers are paying premiums over spot just to secure inventory. You sell a futures contract expecting cheap delivery, but the metal's not there, or it's there at a premium that wipes out your edge. So you stop selling rallies, you cover shorts, you step aside. Paper controls price until it doesn't. This isn't theory, we've seen it before. Palladium in 2019, spot price stayed near $400 while Russian supply tightened. Auto manufacturers who need palladium for catalytic converters started hoarding. Within 6 months, palladium ripped to $2,800. Not because sentiment changed, because availability changed. Rhodium in 2020, similar story. Industrial users locked in multi-year supply agreements at escalating premiums. Spot price went from $5,000 to $29,000 in under a year. The pattern is always the same. Industrial drain meets constrained supply, and price discovery shifts from paper markets to physical scrambles. Silver's bigger, more liquid, more globally traded, so the move will likely be slower. But the mechanism is identical, and here's what you need to sit with. What happens when the institution that spent 15 years suppressing volatility now benefits from scarcity? They don't sell into strength, they let it run. They don't defend ranges, they monetize the unwind. The wealth transfer isn't hypothetical, it's structural. If JPMorgan accumulated 1 billion ounces at an average cost in the mid-teens and silver reprices to $40, $50, $60 per ounce because physical supply can't meet industrial demand, that's not a trade. That's a generational positioning advantage. And retail. Retail watches price charts while institutions watch flows. The people who accumulate during boredom don't sell during excitement. They sell when the next cycle of boredom sets in. We're not there yet. Let's talk scenarios. In the first path, we get orderly repricing. Inventories thin gradually. Premiums rise but stay under 20%. Spot price grinds higher over 12 to 24 months. Industrial users adjust budgets. Substitution happens in non-critical applications. Silver moves from $28 to $45 without drama. The signal here would be lease rates staying elevated but stable, COMEX inventories declining steadily, and no delivery failures. In the second path, we get a stress event, a refinery fire, a mining strike, an export ban that actually sticks. Suddenly, physical premiums spike to 30%, 40%, even 50% over spot. Spot price doesn't move much at first, because futures are still liquid. But the divergence screams. Retail rushes in. Dealers run out of inventory. Mints go on allocation. The signal here would be premium blowouts without corresponding futures moves. Reddit threads full of sold out everywhere reports, and lease rates spiking above 5%. In the third path, we get a policy shock. A major economy mandates solar installation rates that require 15% more silver than current production, or tariffs on Chinese refined silver, or the U.S. decides to build a strategic silver reserve like they're discussing with other critical materials. Demand surges. Supply can't respond fast enough. Price gaps up overnight. Backwardation hits the futures curve. Industrial users panic buy. The signal here would be headline risk from policy announcements, immediate backwardation in near-month contracts, and COMEX registered inventory dropping below 30 million ounces. Could reverse. Policy changes, substitution accelerates. A major mine ramps faster than expected. Your job is to watch signals, not predict outcomes. So, what am I tracking? First, COMEX registered inventory. Normally, it fluctuates between 40 and 80 million ounces, and deliveries happen smoothly. Under stress, it drops below 40 million and keeps falling. Withdrawal notices accelerate. Registered to eligible, conversions slow. Check weekly. Data's public on CME's site. Second, silver lease rates. Normally they're near zero or slightly negative. Silver's abundant. Nobody needs to pay to borrow it. Under stress, they go positive and rising. That means physical holders are charging a premium to lend, which indicates tightness. Watch the spread between lease rates and spot. Widening means stress. Third, physical premiums at dealers. Normally you see 2% to 8% over spot for coins and small bars, with availability within days. Under stress, premiums go above 15%, delays stretch to weeks, and allocation limits kick in. Track APMEX, JM Bullion, SD Bullion. Compare premiums weekly. Fourth, commitment of traders' positioning. Normally manage money is long and commercials are short. It's balanced. Under stress, commercials flip net long, managed money rushes in, and open interest surges. This gets released every Friday by CFTC. Focus on the commercial category. Fifth, China export policy headlines. Normally, there's no mention of silver, and trade flows stay steady. Under stress, silver gets added to the restricted materials list. Export quotas get announced, and licenses become required. Monitor Chinese Ministry of Commerce announcements. Watch Reuters and Bloomberg for secondary coverage. If you're a trader, respect volatility. Use stops. Don't over-leverage. Markets can stay irrational longer than you can stay solvent. If you're a stacker, accept pullbacks. Zoom out. Physical isn't a trade, it's a position. If you're an observer, stay disciplined. Don't chase headlines. Watch flows. There's a risk cluster I'm thinking through here. Diversification matters. Don't make silver 80% of your portfolio. Asymmetry doesn't mean certainty. Think about liquidity awareness. Physical is hard to sell fast. Plan for that. You need patience. Accumulation took 15 years. Repricing might take 3. Work on your information hygiene. Most commentary is noise. Track data, not opinions. Consider counterparty risk. If you hold paper silver, know who's on the other side. And don't forget tax implications. Precious metals have different treatment. Know your jurisdiction, not advice. Risk management. Can't know timing, only structure. If you're watching flows instead of opinions, you're already ahead of 90% of market participants. Most people wait for confirmation. They wait for CNBC to cover it. They wait for price to double before they investigate. You're here now. That doesn't guarantee profits. It doesn't mean you're right. It means you're positioned to see what's happening while it's still quiet. Markets don't move when you're convinced. They move when you're bored. Silver's been boring for a decade. JPMorgan accumulated while everyone else dismissed it. Now, industrial demand is accelerating, physical supply is tightening, and the dominant suppressor has flipped sides. Price hasn't caught up yet. Maybe it will, maybe it won't. But the structure changed. We showed you the patterns. Accumulation, then release. Industrial drain valve. We gave you the watch list. Inventories, lease rates, premiums, positioning, policy. Now you've got the tools to interpret what happens next. Comment below. Have you seen physical premiums change where you live? Delays at dealers? Allocation limits? Share this with someone who still thinks silver's a dead asset. Let them decide. Subscribe if you want more pattern recognition like this. Not hype, not predictions, just signal extraction and flow analysis. And remember, your job isn't to predict, it's to understand. If you stay disciplined, watch the right signals, and don't get shaken by noise. You put yourself in the group that sees before the crowd does. That's where edge lives. Price lies, flows don't. Links in the description to COMEX data, COT reports, and dealer premium tracking. See you in the next one.